back to the KJ Methods YouTube channel. Don't forget to like, subscribe, and share this video if you find it helpful. What we're going to do today is a valuation practice exam. So let's get started. Question number 1. Market value of a property is determined by, let's take a look at the answers. The actual selling price, the most probable selling price between neighbors, the price after applying an assessment rate, or the most probable selling price in an arm's length transaction. What do you think? Okay, so on this particular one, it would be the most probable selling price in an arm's length transaction. If you recall, market value is the most probable selling price, but you must have an arm's length transaction. There are 4 elements to an arm's length transaction. The payment has to be in cash or the equivalent of cash. There has to be open market exposure for a particular period of time, and the parties have to have typical motivation as well as typical knowledge of the market. What we're essentially saying is you don't get true market value unless you are comparing properties that have both been sold in an arm's length transaction. Okay, question number 2. Sally has decided to move to a lovely house next to a railroad track. After years of living there, she has decided that it is time to sell. When the appraiser values the home, it will be most affected by, let's look at our answers, economic obsolescence, physical deterioration, functional obsolescence, or its value will not be affected. What do you guys think on this one? Okay, the answer here is going to be economic obsolescence. This one is pure definitional, guys. Economic obsolescence is when there is something outside of the property that is putting pressure, external pressure on the property and causing it to depreciate for that reason. So her being next to this railroad track is causing this property to depreciate from an economic obsolescence standpoint. If you look at physical would be wear and tear to a property. So the question is going to say something is wrong with the property, right? There's a window broken or sagging floors or something of that nature. And then functional is how the property operates to contemporary standards. If you see a question where it says 5 bedrooms, 1 bath, that's when we are talking about functional. Don't forget that all 3 of these are a form of depreciation. Question number 3. An appraiser is attempting to value a new commercial building in a downtown area. She will most likely use which method of appraising? Let's see what the answers are. Market data approach, depreciation approach, replacement cost approach, or income approach. What do you think the answer is on this one? And these guys, you need to know right off the top of your head. All right, this should be a quick pick the answer, move on. The answer here would be replacement cost approach. You should have an intimate understanding of which approach gets used for what. But here, because it's new and it's a commercial building, we would use the replacement cost approach. Market data is generally residential. When you have a comp available, there is no such thing as depreciation approach. And the income approach, although a commercial building probably could go under the income approach, we would have to have some more information to pick that one, like what the income is, what the rate is of the property, the cap rate. Number 4. 3 vacant lots next to each other, residential area. None are perfect for a home build. Each lot individually is $10,000. The builder decides to combine the lots to make them more appealing. After combining, the lots are now worth $45,000. And so what are our answers here? A, the builder has assembled these lots. B, he has assembled the lots, but he did not get plottage. C, the builder has assembled the lots and did get plottage. D, assemblage is an incorrect term for this scenario. What do you think? Okay, the answer here is going to be the builder assembled the lots and did get plottage. How do I know? Assemblage is the act of putting lots together. So clearly he put the lots together and he got plottage. How do I know he got plottage? Because plottage is when there is an increase in value from putting the lots together. We would expect that if we put 3 lots together, 10,000 each, the lots would now be 30,000. But instead, they're 45. And so anytime you get that increase in value, you get plottage. Question number 5. An appraiser is valuing an income-producing building. Which would he not use in determining net operating income? What are our choices here? Depreciation and expenses, income taxes and vacancies, debt service and depreciation, debt service and reserves. I'll give you a second to think about that one. Okay, the answer here is going to be debt service and depreciation. If you recall, NOI, we have a formula, right? It's PGI, potential gross income, minus vacancies equals EGI minus expenses, which are fixed, variable, and reserves. And so if we have that formula, we can look down and we can eliminate A because we definitely use expenses. In B, we definitely use vacancies. And in D, we definitely use reserves. But what about the C, where I said that C is the answer? Debt service and depreciation. There are actually 3 things that we do not use when calculating NOI. One is debt service, one is depreciation, and the last one would be income taxes. And the reason for that is because we like to see how the building itself is doing, not dependent upon who owns the building. Question number 6. An appraiser is evaluating a property with 5 bedrooms, 3 baths. The comparable has 4 bedrooms, 4 baths. The appraiser will, let's look at the answers. Adjust the subject upward for bedrooms but downward for baths. Adjust the comp upward for bedrooms and downward for baths. Adjust the subject downward for bedrooms and upwards for bath. Adjust the comp downward for bedrooms and upwards for bath. Woo! That's a mouthful. But immediately, you should know, your answer is B here, but immediately you should know that it's not A and C. Get rid of it. Why isn't it A and C? Because the rule is we never, ever, ever, ever touch the subject property. So anytime you see touching the subject, just eliminate it. So just deal with B and D. And what is the rule? If the comp is better, you're going to subtract. If the comp is inferior, you're going to add. CBS, CIA. So let's look at it here. Comparable has 4 bedrooms. Subject has 5 bedrooms. So the comp is inferior, so I'm going to add to the comp. Well, if I look at the answers here, I'm back in B, right? It's upward for bedrooms. But let's continue. The subject has 3 bedrooms. The comp has 4. That means the comp is better. So I'm going to subtract. So B looks like the best answer. Adjust the comp upward for bedrooms, downward for baths. Question number 7. A property has a net income of $6,000 per month and is valued at $590,000. What is its cap rate? Well, let's look at this one. Look at our answers. Not enough information to determine. 12.2%, 1.02%, 8.19%. What do you think? Okay, the answer here is going to be 12.2%. So how did I get to that? Well, let's look. Calculating cap rates. Initially, we're going to just start calculating the cap rate. If you do not know how to use the magic T, please go to my YouTube video on how to use the magic T. I'm not going to go back over it here, but if you go look at the YouTube video, you'll get a really good idea. And actually, I'll also put the link in the comments. Calculating cap rates. So the NOI on this one is $6,000 a month, and the value of the property is $590,000. So what is the cap rate? That's our question. So let's go ahead and make our T. The first mistake that students make here is that they forget to take that 6,000 and multiply it by 12. Don't forget, every time on the top when we're calculating NOI, you must have it on an annual basis. All right, so if we have our 72,000, we put it on top there, right? It's also the smaller number. You'll see that from that YouTube video. And then on the bottom, we put the larger number. I call them small, large. Some instructors call it part whole. Doesn't matter. Smaller number on top, larger number on the bottom. Divide the two, and you will get 12.2%. Big mistakes here is that students will inverse the way that they're supposed to divide. If you have the T in front of you, 72,000 in the calculator first, divided by 590,000, you will get 12.2%. All right, next one, number 8. What would be the most appropriate appraisal report for a condemnation action? This one should be very simple for you. Narrative report, letter of opinion, short form report, and it depends on the appraiser. The answer here is going to be narrative report. We use a narrative report for pretty much anything else that's not regular residential, commercial, tax sales, estate sales, condemnation actions. Letter of opinion would just be an appraiser's letter on a particular date on their letterhead saying that they appraised it, they think it's this amount. Short form is mostly used in residential appraising. Number 9, an example of the principle of substitution would be, let's see what we have. Appraising two properties that are equal to one another. A theory that a comparable establishes the upper limit of prices in a certain neighborhood. Two homeowners exchanging parcels with each other. The inability to sell a higher price home in an area of lower price homes. What do you think? So the answer on this one is D. D, the inability to sell a higher price home in an area of lower price home. Because I asked for an example of the principle of substitution, you should have immediately gotten rid of A and C. That has nothing to do with it. But then we look at B, a theory that a comparable establishes the upper limits of prices in a certain neighborhood. That is true, right? That is essentially the definition of the principle of substitution. But be careful here. I ask you for an example of it. And so what we're saying here is that if you go ahead and price that property too high, it's never going to sell. Because when things are substitutes for one another, the lowest price one will always go first. Question number 10. What would be the most likely approach that an insurance company would use in valuing a property? Market data approach, reproduction cost, replacement cost, gross rent multiplier. Here it is, another one, undervalued. You should know it immediately and be able to pick the answer out. And so the answer here is replacement cost approach. Let's look at the other ones. Market data would be something with comps and residential. Reproduction cost approach, we rarely ever use that. Like, do not pick that answer, right? Because if you remember, reproduction means you have to put it back exactly the way it was. We use replacement cost, which is giving you a nice substitute for today, right? If you had some granite that was 10 years old, we're going to just give you granite off the shelf today, right? It's going to be comparable, but we're not going to give you that exact same granite. And gross rent multiplier, that is not an approach. That is a methodology that gets utilized under the income approach, but it's not applicable here. So how'd you do on that one? That is going to be it for today. Well, once again, thank you so much for coming to the KJ Methods YouTube channel. Don't forget to like, share, and subscribe these videos if you find them helpful. Thank you so much. See you next time.